Hey everybody, Chris Johnson here from Monday Morning Buzz, and I'm here to do one of my favorite things, cover 3 stocks to watch, and today's episode is going to be a special one. It's a Magnificent 7. That's right, I'm going to take 3 stocks from the Magnificent 7, those large cap tech companies, give you the insight, look at the charts, and what to expect as we head into earnings season. That's right, folks. We're going to cover the Magnificent 7 today in my 3 stocks to watch. Before I get into that, let me remind you to like and subscribe so you can get more content like this from Monday Morning Buzz. So, let's first talk about the Magnificent 7. If you haven't heard of them before, a quick explanation. The Magnificent 7 are these 7 large cap tech companies. They become household names. But looking back, how did they get to be so magnificent? Well, it was 2022 and 2023 that really gave them that title, because we were working through a bear market back then. The market was looking for something magnificent to pull us out of a bear market, or at least a safe haven, a safe harbor. And companies like Apple, Tesla, Google, Amazon, you know the large cap names, they became something that people could hold on to. A safety trade, which is weird because they are large cap technology. And most people look at technology stocks as something that's going to be more volatile. Not the case. These have become very popular, crowded even, and I'll explain how that can be a little bit of an Achilles heel. But crowded trades and more or less have turned into the market. That's why they've been Magnificent 7. So, what I'm going to cover today in my 3 stocks to watch are the good, the bad, and the ugly. Now, let me lay this out for you. We're going to go over some fundamentals. We're going to go over a little bit of the narrative behind why each of these stocks is a good, bad, or the ugly. And then I'm going to go through the charts, which is one of the most important aspects that I think you need to follow. And then I'm going to give you a little summary of what to expect before and after earnings on each of these names, because earnings season is approaching. All right, so let's start with the names very quickly. The good, bad, and the ugly. The good, Microsoft, and I'm going to explain in a second why. The bad, Apple. That's right, the iPhone manufacturer finds itself in a little bit of a spot where it's not so good. And then the ugly, Tesla, the EV automaker, running into some bumpy grounds all over the place. And as I said, we're going to go through those charts as I look through these or talk you through the narrative. First, I'm going to start with Microsoft. And this comes down to AI. And AI has been one of the biggest buzzwords right now in technology. Obviously, everybody's heard about AI. I'm going to give you a little different aspect here, though. There's the technology or the backbone of AI that goes to the semiconductor chips, the computing power. And when you talk about that, it's companies like NVIDIA and AMD and Taiwan Semiconductor. Now we're starting to move into the more exciting phase of AI, and that is how companies are going to monetize it or give you and I applications that we're going to pay for in order to use that AI computing power. Microsoft is one of the companies that is at the cutting edge. I've got another favorite that I'll share with you maybe next week, but Microsoft right now is a company that is making the strides that the market is noticing. Think about the last couple weeks worth of headlines with Microsoft. One of the big splashes we saw was the New York Times suing Microsoft and OpenAI because they had used their copyrighted material for the AI learning. In other words, the way that these machines acquire their knowledge and start to apply them. Now, a lot of people kind of freaked out a little bit and said, ooh, this is going to be something that's difficult for Microsoft. Let me remind you of another company, though, and that would be Spotify, that deals with the same type of situation. They use other people's content, artists, podcasters, etc., to go out and make money. They provide a channel for that, an application for that. It's going to be no different with Microsoft. At some point, as this makes its way through the court system, and it will be something that will be drawn out, my guess, and what I expect to see happen, is that Microsoft is going to be paying licensing fees to the New York Times and other people that have that copyrighted material that is being used as a learning curve, if you will, for AI. So this is something that the market, as one would expect, saw a quick pullback and a little bit of a test. But then, as we can see from this chart, Microsoft, it happened right in here, has continued what I call a bullish trend. And I'll point out some things in this chart that are going to help you to understand that. But that is just a little bit of a bump in the road. The bigger news is how AI is making its way to Microsoft's product. They now have Copilot that they are in beta with. I have it on my machine right here, which is that thing that hooks up with Office and all those applications that we use to become part of your AI day. You can do everything from summarizing meeting notes to listening in to giving you suggestions on how to write emails. All of that is, again, how you and I are going to consume AI, and that is the next big frontier for AI. Microsoft is leading the way right now. Last couple of quarters have been great for earnings as the company has announced exactly what they intend to do. Let's take a look very quickly at just a summary of what we see with Microsoft in terms of past performance after earnings. This is looking at the last 5 years, so 20 different earnings announcements. And what you'll see by looking at this chart, and I'll explain it, but blue and the orange line here are the expectations from Wall Street, those analysts, and what they expect to see in earnings per share, and then what the company actually provides. That's that orange line. Notice that the company has done a great job of staying ahead of the analyst community in beating those expectations. It's what makes Microsoft a good long-term hold, in my opinion. Now, let's get down to the nitty-gritty because earnings is coming right around the corner for Microsoft, and I want to make sure that you understand what we could see from the market. Historically, over this last 5-year period, we have seen Microsoft trade higher 2 weeks after earnings almost 70% of the time. So in other words, when that earnings news hits, the next 2 weeks, 70% of the time, Microsoft finds itself higher. It finds itself higher by about 5.5%. So it outpaces the at any time, which is around 1.7% over a 2-week period. So in other words, you can buy Microsoft before earnings and expect to make about 2% regardless of what happens. It includes those negative returns. Those negative returns, about 4%. Let me summarize it for you. 70% of the time, the stock trades higher by an average of 5.5%. When it doesn't, those other 30% of the times, you can expect to see around negative 4% return on Microsoft. That is a good comparison to a couple of the other companies that we're going to look at, and that is why I find it in my good category in terms of the good, the bad, and the ugly. Now, let's take a look at the chart as we head into earnings. And right now, Microsoft is in a great spot from a technical perspective. It's done what I call a breakout. And as we move along and evolve, you're going to have some of these opportunities to do some technical analysis learning with me through our education area. But for now, let me explain it. You see these bands, what I call Bollinger Bands. You don't have to get too technical to follow them. Basically know that whenever we break out, it means the stock is moving into a new trend that is going to take it higher, a breakout. And you can see Microsoft has done a good job of consolidating or moving sideways without really breaking any of its major trend lines. The one I watch is the 50-day moving average, and that's that green line here. This is the one trend line that you can look at and say the trend is your friend or it is not your friend. That old adage on Wall Street. If this is moving higher, there's a 2 out of 3 chance that the stock is going to close higher day after day. So that is a very strong case for the intermediate term to hold Microsoft, 4 to 6 week period. Now, as we head into earnings, you're going to see the stock move up towards that 400 level. From a psychological perspective, it'll be huge for the market to break through that. Round numbers usually bring more buyers into the market when you move above them. I love that about Microsoft, especially with the track record we've seen for the company beating earnings. That bullish trend in the 50-day moving average, along with expectations being relatively, I'm not going to say it, that they're not high, but they're not as high as one would expect. Consistency is what the street is looking for Microsoft. I look at this as an opportunity to ride the stock higher. I am a bull on Microsoft. A break above 400 is going to look to add another 10 to 20%, and I think that could happen over the next 2 to 3 months, maybe stretch it out to 6 months if we run into a little bit of volatility in the market, and that puts you at a stock price. It's going to be around $440 on Microsoft. That is your good stock for the day out of the Magnificent Seven. Next, we're going to move on to the bad, we'll call it. And this is going to be strange for a lot of people to think about it, but it is Apple. Apple has been running into difficulties all over the place in terms of the fundamental story here. We've seen pressures from China in terms of iPhone sales not doing as well as they were expected to do. And China's seeing some slowdowns or at least some bumps in the economy still. The consumer here in the United States is showing some signs of tiring of the iPhone cycle. So in other words, you and I aren't running out and grabbing that iPhone 15, iPhone 15 Pro. Let's face it, the biggest changes that we've seen in the iPhones over the last couple of years have been the cameras. And unless you're using that camera, as we usually do on a daily basis, but unless you're using it professionally, come on. The camera's pretty good already. So we already get the iPhone software. Obviously, they are making money off of the App Store, and you're seeing some a little bit of contention and contesting in the courts on what is going on there. So Apple's kind of getting that foundation or that fundamental part of their revenue shaken up a little bit. We've seen earnings that have kind of slowed here. Expectations remain high. The analysts expect this stock to continue to knock the cover off of the ball, and that's one of my problems. I talked about crowded trades and sentiment. I'll get into how that could be its Achilles heel in just a second. Technically, notice the difference in the chart as I pull it up here between Apple and Microsoft. This stock has been struggling to move sideways. We've seen a top here in December 2022, and every stock rallied from November to December, almost every. Apple was no exception. They actually had a good earnings report here. The stock moved 9% higher, and I'll get into the breakdown of earnings in a second. But when you look at the stock, it's just not as strong in terms of that trend. Yes, that 50-day moving average is moving higher, which means it's in an intermediate term bull trend. But notice that the stock price right now is actually trading below. Versus Microsoft, I'll go back to that chart here so you can see the comparison, which is trading above that 50-day moving average. There you go. There's Microsoft. So a big difference. Trading below means we could see that 50-day moving average and that trend start to level off and not be so friendly. It is technically in an intermediate term bull market and a long-term bull market as it trades well above all those monthly trend lines I watch. But the expectations are the problem as we head into earnings, in my opinion. Apple has been one of those fan-favored stocks. It's been a stock that you really had to hold, and it's because the company was continuing to grow and get into new markets. We're seeing that being shaken up a little bit in China and other markets, including here at home. But notice the difference here, and this is your performance before, or after earnings, rather. So on average, stock is up 63% of the time. It's comparable to what we saw with Microsoft. That at any time, so 2 weeks after its earnings, the stock is typically flat to a little bit negative versus Microsoft being up almost 2%. There's the difference. There's a lot more volatility around Apple. Winning quarters get you about 6% and losing quarters about minus 6.4%. So you've got a little bit of disparity between the higher and lower numbers there compared to Microsoft and the rest of the market when I look at this. That means we tend to see a ton of volatility with Apple's announcements. People buy the news, and this is one of the more popular buy the news, sell the headline stocks out there, and it results in volatility that tends to shake the stock out a little more lower. Let me point one more thing out here. Remember that nice trend that we saw with Microsoft in terms of those earnings and the expectations growing in tandem in nice straight line? Seeing a lot more volatility here in those numbers with Apple. In other words, the revenue and earnings streams are getting a little harder for them to continue to maintain, and that's what results in that volatility in the stock. There is your performance 2 weeks after each one of those earnings announcements. What's that mean for Apple? Well, it means that it is a stock that has to prove itself and make a large argument, a very large argument in terms of the stock moving higher. That's not necessarily a position that the market wants to work through, especially, folks, right now, when we're seeing a market that is really kind of getting a little nervous about recessions and still some geopoliticals out there. People looking for a reason to sell will find it very easily if Apple does not meet those expectations. So Let's go to the technical chart real quickly on what I'm expecting. As we trade up towards that 50-day moving average, I think we're going to kind of level out ahead of earnings. It's about a week and a half away or so in Apple's case. So not much of a buy the news. And that puts us on edge here. And especially Apple. I mentioned the crowd a couple of times. Here's how this plays out. The more analysts that are in love with the stock and the higher target prices they have for that stock, the more pressure for the company to beat expectations. Right now, Apple's in that situation where it's a big question on whether they're going to continue that trend of beating expectations. We saw them actually miss expectations last year and kind of tighten up their outlooks. Puts the stock on edge. And in this case, with Apple being so crowded with buyers and all the analysts loving it, a miss could bring more downgrades. And we've seen 3 downgrades over the last 2 weeks. Just today, one of the analysts in the Wall Street community came out and upgraded the stock, which is the only reason that we're seeing a little bit of a bright spot. Notice how it's moved off that other moving average, the 200-day. So this is a little temporary reprieve before Apple slips below another key trend line. This earnings could be a shaky one for Apple. And if it doesn't go as expected, more analysts are going to come out with downgrades of the stock, and that means you're going to see the stock pressured even lower. I put this in the bad category because I feel as though Apple could see a price of 170 to 150 here over the next 3 to 6 months. This is in line with anything happening with the earnings. So in other words, if we get an inline number on the earnings, they come in and just match expectations. Remember, the street wants to see more. And if you don't feed that machine, it means they're going to get punished. And when they start downgrading it, you'll see more downside pressure. That is the Achilles of being the crowded stock. Think of it with this easy analogy. It's a crowded theater. It's a very crowded theater. And if Apple doesn't perform, so in other words, if there's a spark or a little smoke in the theater, everybody's going to try to run for the doors. And when they do, that brings downside volatility. Right now, at best, I'd be holding Apple. At worst, or if I'm expecting the worst, I would be looking to short it down to the 150. Let me explain one thing right now, though. Earlier, I said I'm long-term bullish on these stocks. I don't think you can jettison Apple from your portfolio completely. So take that $170 price or that $150 price. And if you're not familiar with shorting and you're not that nimble, and again, our education area will show you that as we move forward, how you can do that. But if you don't want to go out and take a position that's going to profit when Apple goes down, simply write those 2 prices down as a price where one might feel comfortable buying the share at a discount or on sale. So in other words, right now, I'd be buying Microsoft ahead of earnings and expecting that price tag of 400 to allow the price to move higher. Right now, a break below this 180 level on Apple is going to take it down to 170, which is where I'd start considering nibbling on the stock. And then ultimately, maybe a price tag of around 150 would be one of those bargain basement prices where I would definitely be interested in adding it to the portfolio. Let's take another couple of minutes here and move on to the ugly category. And this one is going to have people either writhing or maybe cheering a little bit. The ugly today is Tesla. Tesla, just like with Apple, has run into a little bit of pressure in terms of the consumer. So in other words, we're seeing that demand for EVs go down. Not only demand for EVs going down a little bit, but also when you look at it, the competition that Tesla is now facing has grown dramatically. It can be competition from Chinese companies, but more realistic. Let's look here at home. Ford and GM getting into that ring, as well as a few others, Rivian, etc. It doesn't matter the company's names. The fact that there are more players in the space puts pressure on Tesla. And we have seen that. Not only that, though, but when we now look at some of the goals to be reducing the internal combustion engines over the next 7 and more than 10 years here, we're also running into the problems of the fundamental there, the infrastructure. We've seen in the news recently the cold temperatures in Chicago, having people with their Teslas waiting in line 6 hours to get them charged. And when they are charged, they don't go as far because Extreme weather is the enemy of any EV, not just Tesla, but any EV. Combine that with the pressures that we're seeing and a lot of those headlines right now, and I have to put Tesla in that ugly category. Let's take a look at the chart, and you'll see exactly what I'm seeing. Then we'll look at earnings, which have been more volatile. Now, remember that 50-day moving average, that green line that I said the trend is your friend. Notice the negative bias there, the negative trend. That means that same 2 to 3 chance that I mentioned when it's trending higher, that the stock is going to move higher, turns into your enemy. 2 to 3 chance that the stock is going to trade lower each day. And in addition to that, I mentioned the 200-day moving average. That's just a longer-term trend line. And when we hear the trend is your friend, this is just kind of giving your friend the benefit of the doubt when you look at the 200-day. Most of the analysts out there watch that 50 and 200-day. So we have also broken below that 200-day moving average, which is why we've seen an acceleration in the selling. We're also seeing analysts start to put out some big questions about where Tesla's going and some of the moves from Elon Musk, its owner and CEO, or we'll call it the owner. Ironically, he just put out some headlines a few days ago. He's looking to get a little more control of the shares of Tesla. So we're always, I think, going to call Elon the owner. Anyhow, what do I see in the chart right now? Before earnings, I see a stock that is now writhing not only in volatility, but breaking through those trends and getting down to key levels. I've mentioned round numbers. $200, and I've shared this with a couple of my associates and colleagues. $200 is a critical price for Tesla right now. It's only 4 or 5% away from that price. Why? The number 200. The more zeros behind any number, the more psychological effect there is on the market. When we look at the longer term trend, and I haven't done this on the other 2 stocks that we've covered, but if you look at those longer term trends, this is a monthly chart of Tesla. So you'll notice that we topped out at 400, another number with a lot of zeros. Also, if you look at 300 right here, a little bit of proof that those numbers are very sentimental. So that 400, that 300 level acted as resistance here last year, and now we're coming down to this 200. Look at this, 100 on Tesla. Was that support in 2023 in January? So as we come towards that $200 level, we face a stock that is really in an ugly technical pattern and needs to somehow reverse itself. Now, I don't expect to see that from earnings right now because the earnings for Tesla have gone into one of those more defensive postures. 32% of the time, the stock trades higher. Reflect on what we just talked about with Microsoft and Apple, where it was 60% of the time. Only 32% of the time do you actually see the stock trade higher on average after earnings. And that's win or lose. The at-any-time performance is much larger than either of those other companies that we've talked about. 22% of the time, it's trading higher. This is, again, one of the silver linings or the better parts of being an analyst's favorite stock. They come out to defend it. And Tesla is one of the most heavily defended companies. I have even had a rule for years, up until maybe a year or so ago, that you just don't short Elon Musk. You don't bet against him because he tends to prevail. But right now, I think the winds of Wall Street, the winds of the markets and the economy and the consumer are really blowing hard against Elon Musk and Tesla this time around. And I think you have to expect that you're going to see lower prices from the company. But that 22% is a standout. It tells you that this stock is super volatile after earnings. Here's a little more proof. Whenever it's winning, and it has won, obviously fewer times here with a win-loss below 50%, it's won by huge measures, up 30%. And you can see some of these standouts in that bar chart, but they're few and far between. Only 4 or 5 of those standing out. The rest of these have been negative performances, and that's why we get that 32%, about 6%. So right around what we saw from those other 2 Magnificent 7 stocks. But the volatility is my concern here right now with Tesla because the market is trying to get itself away from volatility here lately. As we've seen, some concerns about a recession, everything from a recession to those geopolitical concerns, everything kind of adds up to a market that is really not here to stomach the volatility. We see again in this daily chart, Tesla with that volatility breaking towards a $200 level. It puts it in a must-win situation. And I simply do not like to be on the side of must-win situations when you're talking about investing because they tend to result in some hope. And that hope does something which I call sliding down a slope of hope, which is exactly what I see with Tesla. So it represents my ugly out of the Magnificent Seven. I look at it as it approaches that $200 level and say this is one that it has to win. Otherwise, my price target on Tesla drops down to $150. $150 would represent another 25% discount from its price at $200. At that point, I would consider picking it up again. I do believe that all three of these stocks are very long-term holds. If you're holding a mutual fund, you probably already have exposure to them. So we're talking about individual holding exposure. You're actually buying shares. But if I had the opportunity at 150, which is right now where I'm targeting the stock to move over the next 3 to 6 months, I would be buying the shares at that price. There you have it. A little bit of a summary. 3 stocks to watch here in the Magnificent Seven. You've got Microsoft in the lead right now. I see it breaking after earnings above that 400 level and continuing to move higher. See Apple in a situation where I believe it at best is going to continue to move sideways and struggle, but I think the trend is looking to shift on Apple. At best, I'm a hold looking to buy it at 10-15% below its current price. And Tesla as the ugly, looking for it to break below $200 and possibly give me an opportunity to buy it at $150. So I'm avoiding it ahead of earnings and actively taking a few short positions. So I'm avoiding it as a long-term holder and then taking some short-term opportunities to profit from the downside target. Hope you have a great day. Don't forget to follow, subscribe, like us, do all of the things. You're going to have great content from us here at Monday Morning Buzz. Again, I'm Chris Johnson, wishing you the best trading success. Have a great day, everybody.